As I just mentioned, a bond is a legal contract between the issuer and the bond holders. But as you might imagine, it would be impractical for the issuer, let's say a company like General Electric, to get into a contract with each one of these bondholders. We might actually have thousands or millions of bondholders. So what we need is a party in the middle, and that party is called the trustee. This trustee is typically a financial institution. It could be the trust department of a bank. The trustee is appointed by the issuer, and the trustee holds the indenture or the contract document. And the trustee has the fiduciary responsibility for the bondholders. The trustee largely performs administrative duties to make sure that the issuer is following all the rules that are specified in the indenture or the contract. If the issuer begins to default, then the role of the trustee becomes more significant. But at a high level, recognize the fact that the trustee is in the middle, the trustee holds the indenture and in a sense represents the bondholders. For the rest of this section now, we will think of ourselves as investors or bondholders, and in order to understand the risk and return profile of a given bond, we need to first study the bond indenture very carefully. So what are the items that we look at and how do we evaluate these items? The first thing to look at is the legal identity of the bond issuer and its legal form. The issuer might be a sovereign government such as the United States, and the bond issued would then be called a sovereign bond. Generally, sovereign bonds have very low credit risk, but there can be exceptions. For example, over the last few years, Greek debt, which is sovereign debt, has a low credit rating. This is something that we will discuss in more detail later, but clearly you as an investor need to know who is issuing the bond. We have a large category of bonds called corporate bonds. Here again, you need to evaluate the legal entity that is issuing the bond. Some companies are structured in this way, where there is a holding company and then there are several operating companies underneath the holding company. Sometimes bonds are issued by the holding company. At other times, the bond might be issued by an operating company or a subsidiary. The credit risk will be different depending upon who is issuing the bond. If the bond is issued by the holding company, which has no assets, then the credit risk will be relatively high. The next point to consider is the source of repayment proceeds. In other words, where will the issuer get the money to make the coupon payments and the principal payments? The source of repayments will depend on the type of bond. Sovereign bonds rely on the full faith and credit of the national government. In other words, the national government can raise taxes and generate money that way, or sovereign governments can print money and make payments. That's why the credit risk on sovereign bonds is very low. As a side remark, the credit risk of a sovereign bond will depend on whether the bond is issued in the country's own currency or in another currency. For non-sovereign government debt, so this would be debt issued by a state government or a municipal government, broadly speaking, we will look at how the entity will raise money, whether the money is being raised through taxes or through project generating or through revenue generating projects. With corporate bonds, generally the money comes from the operations of the company. So we'll see later when we evaluate corporate bonds, we need to take a careful look at the cash flows which are being generated and how smooth and how predictable these cash flows are. If the cash flows are high and predictable, then the credit risk will be relatively low. There is a class of bonds called securitized bonds where the collateral consists of mortgages or other financial assets which have a cash flow of their own, and the payments made over here come from the underlying collateral. So when we evaluate securitized bonds, an important aspect is to evaluate the quality of the underlying collateral. For supranational organizations such as the World Bank or the IMF, the funding comes either from the repayment of previous loans. In other words, the World Bank might have made loans to a given country, that country pays the money back, and then this money can be used to make payments to bondholders. Another mechanism would be to use the paid-in capital. The paid-in capital is the money that has been contributed by member countries. When we invest in a fixed income security, we need to understand whether there is any underlying collateral. The reason is that collateral reduces credit risk. But our analysis doesn't stop here. If there is collateral, then we as investors need to understand where we stand. For example, a company might have issued several bonds, and some bonds will be more senior. In other words, those bonds or those bond holders have a claim against the collateral before we do. So bonds where the claim comes first are called senior bonds, or their ranking is senior relative to bonds where the claim comes later. Some other terminology that you need to understand is shown over here: secured versus unsecured bonds. Secured bonds are backed by assets or financial guarantees pledged to ensure debt repayments in case of a default. An unsecured bond means that there is no explicit collateral backing the bond or the loan, but the bondholder does have a general claim against the cash flows and assets of the company. Another important term is debentures. In most countries, debentures refers to unsecured loans. However, in some countries, debentures actually have collateral backing. So the bond indenture will clearly indicate what type of collateral is contained underneath the loan. In terms of different types of collateral backing, here are some terms that you need to know. A collateral trust bond is secured by securities such as common shares, other bonds, or financial assets. Equipment trust certificates are bonds which are secured by specific types of equipment or physical assets. Mortgage-backed securities are backed by a pool of mortgages, and these mortgages are cash flow generating mortgages. So they actually need to be studied in a lot of detail, and this is material that we will see in detail later. Covered bonds are backed by a segregated pool of assets called a covered pool. In some way, they are similar to securitized bonds such as mortgage-backed securities, but they offer a greater degree of protection. Clearly, there is more detail here, but that's all you really need to know at this stage. Next, we come to credit enhancements. This is another way to reduce credit risk associated with fixed income securities. Generally, credit enhancements are used with securitized bonds. We have two categories of credit enhancements: internal credit enhancements and external credit enhancements. Internal credit enhancements could take one of these forms. We could set up a structure such that certain categories of bonds or tranches are protected, and that is accomplished by creating senior tranches and junior or subordinate tranches. We could also have over collateralization where the amount of collateral exceeds the payments that need to be made, so that provides a safety buffer. A similar concept is an excess spread where the return that we are getting from our collateral, for example, if we have mortgage-backed securities, the return that we get on the actual mortgages or the pool of mortgages, if this return is higher or significantly higher relative to the return that needs to be paid to investors, then that also provides protection. So these are all internal enhancements. External enhancements, as the name implies, relies on external parties. The top three items over here, surety bonds, bank guarantees, letters of credit, these involve a third party providing some form of guarantee. But the risk here is that if the third party is downgraded for some reason, then that impacts the credit rating of the bond that has been issued. Another type of external credit enhancement is a cash collateral account where there is actual cash backing up the bond. So this is not impacted by any potential downgrade of the third party. And finally, we come to covenants. This is significant and is explicitly mentioned in the learning objectives. So we have a full slide on this topic. Bond covenants are legally enforceable rules that borrowers and lenders agree on at the time of a new bond issue. Covenants can be affirmative or negative. Affirmative covenants indicate what the issuer must do, and that's why they are called affirmative. These are generally administrative. Examples of affirmative covenants include the following. The issuer must make payments on time. The issuer must comply with all laws and regulations. The issuer must maintain current lines of business, must insure and maintain assets, pay taxes on time. So note that these are fairly administrative, and whether or not this bond indenture is in place, these are things that an issuer would typically do anyway. Negative covenants indicate what the issuer must not do, and that's why they are called negative covenants. These are frequently more costly and materially constrain the issuer's potential business decisions. Examples include the following. Restrictions on debt. This means that the issuer is not allowed to sell more securities or raise more debt because that will increase the credit risk of the existing bondholders. Negative pledges. This prevents the issuance of debt that would be senior to or rank in priority ahead of existing bondholders' debt. Restrictions on prior claims. The objective here is to protect unsecured bondholders by preventing the issuer from using assets that are not collateralized to become collateralized. If you recall from the earlier slide, unsecured bonds do not have any particular assets backing them up. The unsecured bonds have a general claim on the assets and cash flows. So if a company identifies assets and defines them as collateral for other bonds, that would compromise the credit quality of the unsecured bonds. Restrictions on distributions to shareholders. This is fairly self-evident. If the company pays out too much money to the shareholders, then there might not be enough money to pay the bondholders. Restrictions on asset disposals. If a company easily disposes of all its assets, then in the long run, there might not be enough money to pay the bondholders. Restrictions on investments. The idea here is if the company makes additional investments that compromise the ability to pay bondholders, then obviously that will be a concern. Restrictions on mergers and acquisitions. The same idea holds over here. If a company spends too much money on mergers and acquisitions and that makes it difficult to pay bondholders, then obviously bondholders will be concerned. So I hope you see a common theme over here. The basic idea is to prevent the company from doing things which will make it difficult to pay the bondholders on time. I also want to emphasize that these are just some negative covenants, and a company might have some or all of these covenants defined in the indenture. There can also be several other negative covenants. From an exam perspective though, if you know all the material on this slide, you should be in good shape. Let us now work through example 2 in the curriculum. The term most likely used to refer to the legal contract under which a bond is issued is what? So this is a simple question. The legal contract is the indenture. The individual or entity that most likely assumes the role of trustee for a bond issue is whom? A financial institution appointed by the issuer. This looks right. Remember, we drew a picture identifying the trustee organization. The treasurer or chief financial officer of the issuer. This person would not be the trustee. A financial institution appointed by a regulatory authority. That's not true because, as we discussed, the trustee is appointed by the issuer, and typically the trustee is a financial institution. Question 3. The individual or entity most likely responsible for the timely payment of interest and repayment of principal to bondholders is the trustee, primary or lead bank of the issuer, treasurer or CFO of the issuer. This is slightly tricky. You can very quickly rule out B, so the options are either A or C. And the correct answer is A, because as the curriculum points out, although the issuer is ultimately the source of payments, but it is the trustee who ensures that timely payments are made. And that is the key word over here. Responsible for timely payments, that is the trustee. The major advantage of issuing bonds through a special purpose vehicle is what? Now, just as a quick recap, you have a particular issuer. This issuer is also sometimes called the sponsor. At times, the issuer will create an entity called a special purpose vehicle, which is a legally separate entity. The collateral then is legally transferred to the SPV. The SPV issues the securities. So the legal entity issuing the securities is the SPV. Now, if the issuer or sponsor defaults, the bondholders cannot come and claim the assets of the issuer. The big advantage of this exercise is bankruptcy remoteness. The category of bond most likely repaid from the repayments of previous loans made by the issuer is, and we talked about this briefly, supranational bonds. These are bonds issued by organizations such as the World Bank or the IMF. The type of collateral used to secure collateral trust bonds is most likely, and we talked about this, The best answer is securities. Mortgages are used to back mortgage-backed securities. Physical assets could be used to back various kinds of bonds. The specific example that we talked about was equipment trust certificates, but any loan could be backed by physical assets. The external credit enhancement that has the least amount of third-party risk is, and here the correct answer is cash collateral account. Both with surety bonds and letter of credit, if the third party is downgraded, then the bond obviously will become less creditworthy. With a cash collateral account, there is actual cash backing up the bond, so here we have the least amount of third-party risk. An example of an affirmative covenant is which of these? That the dividend will not exceed 60%. There is a not here, so this is negative and therefore not right. To ensure and perform periodic maintenance on financial assets. This looks right. Debt to equity ratio will not exceed 0.4 and times interest earned will not fall below 8. So this also looks like a negative covenant and is therefore not right. B looks affirmative and it is administrative, so B is the best answer. An example of a covenant that protects bondholders against the dilution of other claims is a restriction on. So here the best answer is A, because if more debt is issued, then clearly there will be a dilution of claims. A company has a certain amount of assets and cash flows, and if the company keeps issuing more debt, then there will be a dilution of claims.